I was asked the other day whether it is better to invest surplus capital or use it to pay off mortgage debt. So I thought I'd answer it now for your benefit too. And like everything, the answer depends on a number of different factors, but we can break it down broadly into three areas. What term is remaining on the mortgage, so how long you have left before you have to pay back the debt, your willingness to be exposed to investment risk, and what the interest rate you're paying on that mortgage is. So first of all, thinking about the term you've got left, if you need to pay back the mortgage debt or other loan within 2 to 3 years, you're probably better paying off the mortgage debt now, because there's always that chance that the investment markets will go against you in the short term and you risk getting back less than you put in. Whereas in paying off that debt now, or at least reducing it, will minimise and reduce the cost that you're paying in servicing that debt. If you're a particularly nervous investor and you don't want the capital to be exposed to the vagaries of the stock market, you might also be better paying off mortgage debt now, because if it's going to cause you more angst, more worry, more sleepless nights, knowing the capital is going up and down in value on any day, week, month, yearly basis, then it's probably not right for you to invest. Otherwise, if you're someone who's prepared to take that investment risk and see prepared to watch the value go up and down, and you're comfortable with that, you might be better placed investing it. Particularly if your mortgage interest rate is particularly low, and we're in a period now where we have got historically low interest rates and therefore mortgage rates. So if your mortgage is 1 or 2%, you might expect to get better on average over the medium to long term from an investment. So to use an economic term, there's an opportunity cost of paying off a debt at a lower interest rate than you could get if your money's invested. So that is something to consider. Another option might be to invest the capital in a pension, and the amount you can do will depend on a number of factors which isn't appropriate for this video now, but by investing the money into a pension you would get a tax relief either at basic rate 20% at source and possibly at 40% or 45% depending on your tax rate. So you're immediately getting an uplift on that capital compared to when you're paying if you're paying off debt. You'd have to think about accessibility to that pension. So at the moment you can only access a pension at 55. So if you'd need to pay off the mortgage debt before you can access the pension, it wouldn't be right committing it to a pension when it's not accessible to you. So a number of different things to consider there. When you need to pay off the mortgage, how comfortable you're investing, and the relative return you might get by investing the money compared to the interest rate you're paying on that mortgage. So I hope this helps you with those your decision making about whether you invest capital to pay off a mortgage or just reduce the debt now.